All right, we are going to go ahead and head into Chapter 3, the balance sheet. Like I said, we just do not have enough time to cover cash and accrual accounting as extensively as I had hoped to. But again, that was a new lesson that I had wanted to incorporate and not something that I had been doing over the years. So you're not missing out on anything that was, I think, necessarily essential for your understanding of accounting. It's just a little bit extra that can add extra perspective and enhance your understanding of the material. So let's go ahead and move into the balance sheet. This is something that is obviously essential to your understanding of accounting, and I want to make sure we have plenty of time to address it, the income statement, and the statement of cash flows prior to your first test. The objectives, as usual, are there for your help, but I don't need to run through them. So let's talk about what the use of the balance sheet is. Now, a lot of time people have an issue with misunderstanding the balance sheet as a statement that helps show profitability. It does not show profitability. Profitability is the purview of the income statement. What we get from the balance sheet, of course, is information about the assets, the liabilities, and the equity of a company. But what we are looking at in terms of a financial health characteristic is not profitability as much as the examination and the assessment of risk. So how do we look at risk? What is risk? And how does the balance sheet shed some light on whether or not a firm is inherently risky? So looking at accounting measures of risk, and it's important to denote accounting measures of risk because certainly other business disciplines have their own measures of risk. There is market risk, financial risk, operations risk, any sort of risk that you could think of. And what is accounting's take on risk? It's not the market beta, but what we have instead is an idea of short or long-term risk ratios that we analyze. Now, something that you really need to always take into account when you're looking at a ratio is that it's difficult to characterize a ratio as good or bad on a standalone basis. So there's really no absolutes in ratio analysis such that, well, if you have an interest coverage ratio greater than 15, or if you have a current ratio greater than 1, then you're good. What you always have to do is take into account the context of the ratio. You have to think about what are the macroeconomic trends. So, has the economy been plummeting? Is there a liquidity crunch in general? Those sort of things will elucidate whether or not the risk is acceptable or unacceptable for the particular company. And also you have to understand that different industries have different trends. Some industries are just going to have current ratios that are inherently larger than other companies. And so when you're judging whether or not the risk of this company is good or bad, or any ratio in accounting, you really do have to kind of take into account the entire context of what's going on. So that being said, let's look at these different types of risk. Liquidity is a short-term risk, right? We're looking at the ability to convert assets into cash over a short period of time. So this is our short-term risk ratio. And all we do is look at current assets and current liabilities and form them into this current ratio where we put current assets over current liabilities. Now, certainly a measure over 1 indicates that we have more than enough assets that we can convert into cash to meet short-term debts. So all these debts that are going to come due in the next operating cycle or in the next period are going to be able to be met by our current assets if this measure is over 1. Now, again, is a measure over 1 a good measure? Well, it does say that we can meet our current liabilities, but it might be that your industry, all the companies, or the average current ratio in the industry is 3. And so if you have anything less than a 3, it might be a little bit circumspect as to whether your company is doing something incorrect or something deviant from most of the companies in the industry. Along with the current ratio, we have a modified quick ratio, which removes the less liquid current assets from the mix. So we get rid of prepaid assets. prepaid insurance, prepaid rent. We also get rid of inventories. And so what you're left with in the current ratio, or I'm sorry, the quick ratio, after you get rid of those things from the current ratio, is going to be, of course, you have your cash account, you have what we call marketable securities, which we'll discuss in a second, and then you have your accounts receivable. And then that is divided by your current liabilities. And so this is a little bit more conservative of a measure because it backs out certain assets that would otherwise be counted in the current ratio. Another liquidity measure is just assessing the difference between current assets and current liabilities. And you could take that difference and determine whether or not the firm that you are looking at has a good amount of assets to cover its liabilities. Notice that this is just sort of net assets, except we're looking at only the current ones. Solvency is looking at a long-term perspective of risk. So the current ratio and liquidity looked at our short-term. Long-term risk is examined by looking at a solvency measure. And so when we're looking at a solvency perspective, we're looking at all of the assets and all of our liabilities. Now, sometimes we might just look at our financing liabilities. We'll talk a little bit about what I mean by that. Financing liabilities are those liabilities such as bonds used to finance operations. And we would remove operating liabilities. But like I said, we will look at that a little bit more in detail. Total assets divided by total liabilities gives me an idea now, not just whether the current or whether I'll be able to have assets enough to meet my current needs, but whether I will have current and long-term assets that will meet all of my needs as all these liabilities come due in the future. And so it's a little bit more long-term of a window that we're looking at. Capital structure is another way to gauge the risk of a company. It's just looking at the relative precision, the relative percentage of assets that have been financed by equity versus debt. So in order to form this ratio, we take total liabilities and divide it by equity, or again, we can just use the financing liabilities and put those over equity as well. Whether or not you have an optimal capital structure is going to be dependent on a number of factors. Again, the industry that you're working in and the current economic trends of the economy would dictate to a large extent what companies' capital ratios are looking like. But in general, if you have too many liabilities, you could face bankruptcy, because once you have too many liabilities, you have a lot of interest payments to be making on those liabilities, and that could force you into bankruptcy if you miss interest payments on your debt. Financial flexibility is a different sort of measure, and it doesn't have any one ratio that encapsulates it. Financial flexibility is the ability of an enterprise to take action so that it can respond to unexpected needs and opportunities. So for example, if a new project or some new market niche comes down the pipeline, is your firm going to be able to respond to it in a timely fashion? Are we going to be able to, do we have enough liquidity to mobilize assets to install new product lines, to pour money out of a budget so that we can take advantage of this opportunity? And that's really going to depend on whether you have a lot of money tied up in debt, a lot of money that you have to pay in interest, or whether you have a lot of liabilities coming due in the near future. And so financial flexibility is sort of a summary measure of all risk measures. You need to have some liquidity, you need to have some long-term solvency, and you also have to have a decent capital structure so that you can leverage yourself in order to take advantage of those opportunities. So if the balance sheet is useful in assessing risk, what are some of its limitations? Well, the common criticisms of the balance sheet are that market values are not commonly reflected. So, of course, we have a lot of assets at historical cost. Assets that are at historical cost typically are our fixed assets. Also, sometimes inventories will be held at historical cost, and other items throughout the balance sheet. Sometimes we have most of our payables at historical cost, and so some people say this is a rather um, antiquated way of expressing value. Sometimes we will use market values when we're holding assets for sale. If we're holding assets for sale, but more specifically, if we're holding them for speculation. So if we buy some land and we just bought the land because we speculate that the value of that land is going to increase, then that land is not property, plant, and equipment because we're not using it for productive purposes. It's an investment, and then we would hold it at its market value. Most short-term investments, okay, these are the marketable securities that I referred to and that we will discuss on the next page. Those marketable securities are going to be held at current market value because the idea about marketable securities is that these are things that the firm has invested in simply to turn around and sell and earn a short-term profit on. Another criticism that's lobbed at the balance sheet is that estimates and judgments are needed. And this is going to be again and again the case in accounting. On the balance sheet, we have the collectibility of receivables. Remember, whenever we assess the collectibility of receivables, we assess the allowance for doubtful accounts, which is a contra account, which reduces our accounts receivable. The useful lives of long-term assets forms accumulated depreciation, which again is another contra account that reduces the value of our fixed assets. Inputs into complicated valuation models are also used for certain financial instruments, and we'll talk about that a little later on, actually much later on in the final chapters, and that is also a big deal that's going on now, especially for banks and financial service firms. Some other people say that there are items of financial value to the business that are omitted. You know, the value of a company's human resources, their research and development, those things are not reported. This is not reported, the company's human resources. So like, you know, employee morale or employee competence. And remember, that's not going to be reported because of the not the economic entity assumption, but the overriding factor that we need to have and each of these items expressed in a currency and not just in a sort of, well, they're very intelligent, that they are highly productive, that our CEO is highly intelligent and business savvy, doesn't fly in terms of expressing a value. The research and development, remember, is not incorporated into the balance sheet because of conservatism and the matching principle. Remember that we just go ahead and send it as an expense through the income statement. We don't have any sort of research and development and process asset that we accumulate. Also, sometimes we can structure transactions, and this is something that got Enron in a lot of trouble, is that sometimes we have liabilities and leases that are off the balance sheet. So the way we structure these items, they're not reported on the balance sheet. And so that's also a problematic item. Current assets. So we're going to start talking about all of the assets. And this is probably, no, not probably, but this section of the balance sheet has the most classifications that you're going to have to put a handle on. The current assets themselves are broken into a good number of subsections. And so we're going to take a look at all the assets, and then we'll switch and go to the other side of the balance sheet. I will probably break off after assets and split the videos in two. But current assets are resources which are expected to be turned into cash, are going to be sold or consumed within a year, or the operating cycle, whichever is longer. So most firms, most companies will have an operating cycle within a year. So typically, the operating cycle is less than a year. So who has an operating cycle over a year? Well, an operating cycle is the moment that you spend money on a project to the moment that you recoup money from that project. And so if you're thinking of firms that have an operating cycle longer than a year, typically you're going to be thinking about firms in long-term construction, long-term contracting. Those sorts of firms will have contracts that will typically extend beyond the period of a year. Whereas, most companies that we think about, retail companies, they're making sales every day. Their operating cycle is within a matter of, a day for sure, even within a minute. Cash and cash equivalents is always, cash and cash equivalents are always the first item listed. Notice that when we prepare the balance sheet, what we're going to be doing is moving in order of decreasing liquidity. Okay. So we go from the most liquid items, i.e. cash and cash equivalents, all the way to the least liquid items, which would be intangibles and other assets. So remember, liquidity is how readily something can be converted into cash. Well, cash and cash equivalents are already cash. Well, cash is, and cash equivalents are basically almost cash. So what are cash and cash equivalents? You know what cash is. The cash equivalents are items with original maturities of 90 days or fewer. So items that fit in this, and we'll talk more about this in Chapter 7, commercial paper, short-term treasury bills. So any securities or any investments that will come due, that will come and give us money, cash, in 90 days or fewer. And the idea of having 90 days or fewer is that there is no uncertainty of interest rates. And that makes it so that our value is fixed. Right? So swings in interest rates can have a very large effect on the value of investments if we have an investment that is going to be earning for 5 years, obviously. A 5-year trajectory, any swing in interest rates is going to greatly decrease or increase the final value of that investment. But once we have within 90 days, interest rates start to make less and less of an impact on the value of items. Another peculiarity that comes up with cash and cash equivalents is items that are legally restricted. Okay, so some cash that the company has is going to be legally restricted for a particular business purpose, and it needs to be recognized on another line item. All right. Then if it's short term, it's going to remain current, but it still needs to fall right below, and it'll end up between cash and marketable securities, and it'll actually be called restricted cash. If the item is restricted for a long-term purpose, then it has to be put into long-term investments. Right? So for example, if we have some cash that's legally restricted for bonds that don't mature until 5 years from now, and that would be called a sinking fund, that needs to be set aside in long-term investments. If the cash is not legally restricted, then we do not have to separately recognize it unless the amount is material. So unless it would make a difference in our judgment of the liquidity of this firm, then we do not have to separately disclose that cash if it is not legally restricted. If it is material, even if it's not legally restricted, it needs to be separately recognized. Regardless, we have to disclose in the footnotes. Marketable securities is the next most liquid type of asset. And these securities are just short-term investments that the company is going to make in other companies' stocks and bonds. And the key idea here is that they're looking to sell them quickly if they are classified as a marketable security. So investments in other companies' bonds are going to be called debt securities, as they represent the debt of those other companies. Now, when our own company issues debt, we call that bonds. So don't get the two confused. Debt securities are not a liability. These are an investment in the debt of another company. When you invest in the debt of another company, what you're typically looking for is to get the fixed payment of interest for those debt securities. However, swings in interest rates can cause the value of these instruments to change. So you could also be investing in them for a short-term gain. Investments in other companies' stocks are called equity securities. And again, don't get this confused with our own company's stock, which would be called common stock or capital stock. Equity securities are the stocks of other companies. And when we invest in these sort of securities, what we're looking for is the potential appreciation in the value of the stock, so that we buy it at, say, $10 per share, and then we can turn around and sell it when the stock price rises. Maybe it goes through the roof to $21, and then we can sell it off and make $11 per share stock we own. And we're going to find that these equity and debt investments are going to be classified into three categories based on the intent of management, which is kind of an interesting classification scheme. You know, there is no fact. It's just managerial intent. You know, it's kind of like, well, I intend to go, or every New Year's, I intend to do 5 new great things in my life, and then I just never follow through with them, right? Well, the same thing's true here, right? Management can intend on doing something, but it doesn't necessarily have to follow through. I'll let you read through this for the most part, but the three classifications, so that you know their names, are trading securities, available for sale securities, and held to maturity securities. And the managerial intent with each one is going to be for trading securities to be sold in the short term, right? They're looking for a short-term gain, and therefore they are only designated as current securities. Held to maturity securities are, as the name might suggest, bought to be held to their maturity dates. Now, because equity has no maturation, this is only for debt instruments. It could be either current or long-term, but they are typically long-term investments. Now, anything between the two, bought to be sold in the short term or bought to be held to the maturity date, are going to be what we call available for sale securities. It's a sort of gray area. The intent is not clear. They want to sell them, but not in the short term. They're going to hold on to them for a while. And as you can see on the side, the valuation that we use for these items depends on which one we're talking about. For trading securities and available for sale securities, we use their current market values. For held to maturity securities, we use what we call amortized cost. The next most current asset, and again, remember, we are moving in order of decreasing liquidity. The next asset is accounts receivable. We're still in current assets. Accounts receivable are reported at their net realizable value, and that's the amount that we anticipate on collecting. Remember that we value some items by their expected exit value. That is the amount we expect to get when we sell them. Now, we're not really selling receivables, we're collecting them. So what we're looking at with the NRV is the total debit balance of accounts receivables less the total credit balance for the allowance for doubtful accounts. Remember, the allowance for doubtful accounts is a contra account. So the accounts receivable account looks something like that. The ADA account, because it's a contra asset account, has the opposite rules of an asset account. It has a normal credit balance. We add whatever balance is in the accounts receivable, let's say $10, to the ADA balance, which is, say, $2. Because it's a contra account, we combine those two, and we have accounts receivable net of $8. So remember, this is how contra accounts come into play, and adjunct accounts would actually increase the balance of their parent account. So on the balance sheet, we see accounts receivable expressed net of the bad debts or the allowance for doubtful accounts, and that is one of those contra accounts. Inventories are your fourth type of current asset. Remember, inventories are not included in the quick ratio. Because the quick ratio is a more conservative measure of liquidity, so it bumps out these two less liquid current assets. Inventory are items which are intended to be resold in the ordinary course of business operations. So anything that we buy with the intent to resell that is not an investment is something that we would consider an inventory. Inventories are valued at the lower of their assumed cost method. Remember your friends from intro to financial, LIFO, FIFO, weighted average cost, etc. So that is their assumed cost method that influences their value or their estimated market value. So the lower of those two is the value we assign to them. And remember that this is an application of conservatism, that when two estimates are equally feasible, we take the one which will understate assets, right? We take the lower of their cost or their market. Prepaid expenses are largely made up of these prepaid insurance, prepaid rent, prepaid, any other asset you can kind of throw around there. There are deferred charges or deferred expenses. Sometimes that's what they're called on companies' balance sheets. You report the unexpired cost, that is the amount that's remaining. Now, one caveat here is that if the prepaid goes beyond the current operating cycle or a year, then we report the deferred charges that are beyond that period in the other assets section. So let's assume that we have a company with a current operating cycle less than a year, and they have a prepaid insurance contract that will last them for 3 additional years. Well, in that case, we would only report 1 year as a prepaid expense, and then the 2 years beyond that, because it's lasting 3 more years as of the end of the reporting period, those last 2 years would be a long-term other asset. Okay. We'll come back to that again when we discuss other assets. Long-term investments now represent the first item we see that is not a current asset. And again, notice that these things are still in decreasing order of liquidity. So it's much easier to liquidate an investment than it is to liquidate a fixed asset, right? Investments, typically you can find an actively traded market, whereas property, plant, and equipment, you're going to have to find a much more niche buyer in order to take your equipment off your hands or to buy the building that you're operating out of, and that sort of item. Okay. Long-term investments represent items that management intends to hold for an extended period of time that is past a year. Investments in securities, debt and equity securities that are designated as long-term. So remember, some of these securities would not be current, but would be long-term. Available for sale securities can be long-term. Held to maturity are typically long-term. And so those items which are long-term would fit down here. We still value available for sale securities at their current market value, and held to maturity securities are going to be valued at the present value of future cash flows, which is their amortized cost. So it's 2 words that describe the same idea. We will investigate fully what amortized cost is when we get to chapter 12 and 14. Long-term notes receivable are long-term investments. These could be promissory notes of payment that the reporting company will be due. So, someone owes us some money. Perhaps they bought some equipment from us or bought some services from us, and they're paying us back over a course of 2 years. Then that would be a 2-year note receivable. And again, also held at amortized cost, the present value of future cash flows. Any investments that are set aside in special funds, so this is that restricted cash I talked about. Sinking funds, pension funds, plan expansion funds. This is any money that's earmarked to pay future debts. Also, you could see some accounts like the cash surrender value of life insurance on key executives. So that would be whether the amount that you could cash in an executive life insurance policy. Companies will insure their executives, especially their CEO, so that at their death, they have a sort of kickback that they can collect. Again, that cash that's legally restricted for long-term purposes, and like I said, oftentimes connected to the investments that are described above. Land or other resources that are held for speculative purposes. That is, what does speculative purpose mean? It means that they're held to be sold after an increase in value, and we disclose those items at fair value, not at their historical cost. So we see now that just because something's land doesn't always mean it's going to land, pun, land in the property, plant, and equipment section. I really didn't intend that. However, it really depends on the purpose or the use of the item. That's how we will disclose and choose to classify the items on the balance sheet. So that's long-term investments. We then move into property, plant, and equipment. These are our fixed assets, sometimes called fixed assets. Brick and mortar companies have a lot of property, plant, and equipment. Manufacturing companies have a lot of this. Durable physical property that's used in the operations of the company. And that's a very key item here, right? Because if we have land just for speculative purposes, it's not used in the operations of the company. Therefore, it's not property, plant, and equipment. So if we're using it in order to generate revenues, then it's property, plant, and equipment. Typical classifications in this are land, buildings, machinery, equipment, and fixtures. Natural resources are also property, plant, and equipment. So items that we have licensed to harvest, timberland, minerals, precious metals. Those would be property, plant, and equipment. They're valued at historical costs, less accumulated depreciation, except for land. There is no depreciation applied to land, but that is their book value. Long-lived costly tools are usually included in this category, but small tools are usually expensed from purchase and included in current assets as supplies. So remember the whole pen example. This pen is not going to be a long-term asset. It's something that we would just put in the supplies account and have at our firm. Right? And supplies would be a current asset. Intangible assets are followed property, plant, and equipment because, again, we have decreasing liquidity. And if it's hard to sell a building, it can be even harder to sell rights that are intangible. So these are resources that lack physical substance but provide economic rights and advantages. So we have patents, franchises, copyrights, goodwill, trademarks, trade names. Intangible assets and fixed assets are something that you'll cover more extensively in Intermediate 2. The difference between intangible and fixed assets, a sort of superficial difference is, and a lot of people will say, well, intangible assets, you can't touch them, right? You can touch a building, you can touch equipment. Well, that is true. But really what makes them intangible is their uncertain link regarding the realizability of future benefits. So maybe this patent will be great. Maybe it'll provide tons of money because this is something that everyone wants, right? But that's not necessarily the case. You're taking a gamble with a patent. You're taking a gamble with buying someone's copyright. Their trademark or trade name may or may not pan out to be worth much. So what are the returns to that? It's hard to measure. Go back to our whole discussion about research and development, having uncertain revenue generating capabilities. These sorts of assets are especially prevalent in high-tech, biotech, and pharmaceutical industries. And remember that expenditures for some intangible assets, such as R&D, are not capitalized. So they are not, capitalization means accrued into an asset account, but they are expensed as incurred. So recall that when we spend money on research and development, we are not debiting, Cure for Cancer account and crediting cash because we're spending money. We're debiting research and development and crediting cash. So for that reason, suppose I spend $1 million developing a patent. they're paying in-house scientists and purchasing lab equipment, funding studies, I still wouldn't be able to record the patent at $1 million, not even when I discovered it was feasible, that I actually have a patent that could be filed. All of that would only be recognized as an expense. According to accounting rules, the patent that I developed in-house would only be listed at the cost of its filing fees and any costs in the future that I spend attempting to defend it against infringement. And that will typically be a very tiny, tiny percent of the total amount spent to develop the patent. So long story short, your intangible assets will have little to no value on the balance sheet if they are internally developed. Now, if you go and buy one from another company, you can record the historical cost. As I say here, in-house will be only the filing fees and the costs to defend it. But if you buy it from another company, then you will actually be able to record the amount that you paid. Now, these intangible assets have a book value that is their historical cost or these filing fees less any amortization, which again is just depreciation that is applied to intangible assets. But there's no accumulated amortization account. The other assets that I mentioned prior is just a special classification for unusual items that cannot be included in another category. So like I said before, those deferred charges, long-term prepaid expenses, also something called the deferred tax asset, which you'll talk about in Intermediate 2. Another one that we see end up here sometimes is property, plant, and equipment that we do not any longer use for a productive purpose, but it's held for resale. And that would now come down to the other assets section. Now, something that's interesting is that once we retire this item from productive purposes, we would stop depreciation. I want you to think about that. I will ask the question in class, why would we stop depreciation? And we'll have a little discussion about it. But remember, we're not using them for productive purposes anymore. We take them out of property, plant, and equipment, drop them into other assets, and we stop depreciation. We no longer depreciate that asset. And we do that even if there are still useful years left in its life. So I'm going to wrap up with that. There is a table that I created that you can look at for a sort of summary about each of the categories of assets and how we value them. And that's really kind of the big ideas in this chapter, is learning the different classifications of these assets and how that affects their value. One other thing I want to reiterate is that classification depends on both the nature and the use of the item. So, for example, land can be disclosed many ways. If it's a factory site, it's property, plant, and equipment, historical cost. And if it were a different fixed asset, it would be historical cost less accumulated depreciation. But remember, we do not depreciate land. Land owned by a realty company and held for sale, or a building held by a commercial developer, right? Now, this is something we intend on selling, is inventory. It would be a current asset and valued at the lower of cost or market. Any idle land or facilities that have been withdrawn from production are classified as other assets. Land doesn't have accumulated depreciation again, so just historical cost in its case. And then remember, there's even another case, land held for speculative purposes. This is an investment that we decided to buy because we are buying it and then we think the price is going up, then we're going to sell it. The purpose is to sell. The purpose is an investment. It's not the ordinary course of business, so it's not inventory, and we hold it at its fair value. Okay, so we'll pick up in the next part of this module with current liabilities and equity, but for now, that will do it.